Hello, everyone, and welcome to the live virtual classes from the Institute. We have a topic on paper 4, which is direct tax laws and international taxation. The topic that we have for today is transfer pricing. I am Kriti Chawla, and before we actually get started, I thought I'll talk to you about me and then what is the plan of action for today. I am a chartered accountant. I'm a company secretary, and I've also done LLM in international tax law from King's College London. So it's practically more than a decade now that I've been practicing in transfer pricing, and this is the subject area that I also teach for CA final students. So without any delay, this is the plan of action for today. Before we actually get started, I just wanted to talk about a few things relating to today's presentation. If you have any questions relating to a particular topic that we're discussing, I'd advise you to either put it on the chat tab on Zoom, or you can, put it on the ICAI portal. I will be switching through the portal and, looking at questions there. Or if possible, you can also unmute yourself and ask the question. I'm happy to do that as well. That's for the questions. I don't necessarily want you to wait towards the end of the presentation to ask a particular question. So if you have doubts or if you have questions, throughout the presentation, as we're discussing a particular topic, just feel free to drop in your questions there itself. So slides are visible. I am audible perfectly. Okay, great. So we'll get actually started with this particular topic. Now, if you actually look at the chapter in your module relating to transfer pricing, what I've actually done is I've divided the entire chapter into 3 parts. The first part is this particular slide deck, which will be talking about introduction and concepts relating to transfer pricing. So today we'll be talking about very basic things like what is transfer pricing, what was the gap that was there, so that they actually brought in something called as transfer pricing. So what was the need to have transfer pricing? What is the concept of transfer pricing? And then some key terms that I'll talk to you about, जो transfer pricing में बहुत ज़्यादा important होते हैं समझना. Something like what is controlled transaction, what is uncontrolled transaction, etc. Then we'll go on to discussing in the second slide deck, we will talk about methods to determine the arm's length price. So there are 5 methods in the OECD, and then there are 6 methods in India. We will be discussing all those 6 methods in a lot of detail, and then I'll talk about something called as benchmarking analysis. So that is slide deck 2. Now, the third slide deck will cover things like dispute resolution in transfer pricing. So what is something called as APA? How do we resolve disputes when it comes to transfer pricing? And then we'll also talk about, some specific issues like interest, deductions, safe harbor rules. We'll also talk about interest limitations, etc. So this is all for, the third topic in all. So this is, and also something called as secondary adjustment, primary adjustment. Those are specific issues that I've kept for the third slide deck altogether. So what I'm trying to say is that there are 3 slides that I will be, using. This is the first slide deck, and then there are 2 more. So that's how I've divided the entire chapter. We will be meeting 5 times to actually discuss the entire concept of transfer pricing. So there are 5 lectures which are actually devoted to transfer pricing itself. So what I'd actually advise you to do is, if we're discussing this slide deck today, and if you have any questions relating to this particular slide deck, you can ask me in the next lecture as well. So this is how you can roll over the questions to the next class also. So as far as today's plan is concerned, this is what we have. We will be discussing, the introduction to transfer pricing. What is the need? What is the concept? And as I mentioned, the key terms to transfer pricing. Then we'll discuss what is arm's length principle, arm's length price. Then I'll tell you about the transfer pricing regulations in India. So, what are the sections? What is the chapter in the Income Tax Act of 1961 that deals with transfer pricing? And then we'll discuss, terminologies like associated enterprises, international transaction, and deemed international transaction in a lot of detail. Now, right now, you might be thinking that these are what is she even talking about? What is arm's length principle? What is AEs, associated enterprises, international transaction? But with time, it'll come in easy. So just right now, I just wanted to tell you that this is all that we will be, discussing. Another thing that I want to actually talk about is that throughout the entire 3 hours that we have for today, we will be taking two short breaks, very, very short breaks after every hour. So I just, humbly just request you to be a little more attentive in 1 hour that we're discussing. So 6 to 7, we will be discussing the need and the concept of transfer pricing. Just be a little attentive. And if you have something, if you have anything, calls to take or calls to make or in any thing, you can do that in that break time that you have. So I just request you to be attentive for 1 hour right now, and then we can take a short break. um on on the mode of teaching, I generally teach in English language, but anyone who has a problem, I can just um you know adjust accordingly. So if you have any problem, just put it in the chat box. If throughout the entire presentation you feel that she's taking things a little too fast or little too slow, just let me know in the chat box, and I will take that as a feedback, and I'll adjust to your requests accordingly. So yes, let's get started with this particular thing. So the first thing is, what exactly is the need for transfer pricing? Before we have this particular topic, also, there's one more thing that I want to talk to you about, is that throughout the entire presentation, what I have done is that I've put in a lot of examples. So if you actually see, when we go to the important concepts, if you see, there are examples here, there are examples here, another example, then there is another example, and there is another example. I've put in a lot of examples throughout the entire presentation. And what I've also done is I have picked up questions from past papers, and I have put in those questions also throughout the entire slide deck. So we will be discussing examples, we will be discussing past questions, past papers, questions. And what I've also done is, through the end of a particular topic, I have also put in practice questions. Now, these practice questions are exactly the ones that have been put in, in your module on transfer pricing. So we will be discussing that as well. So you don't have to worry about, examples and questions. And I will just make sure that I prepare you from a practical standpoint when it comes to transfer pricing. And I will also prepare you from an examination point of view when it comes to transfer pricing. So you don't have to worry at all. So, without much delay now, we'll get started with the first thing out there. What is the need for transfer pricing? What was the problem that was occurring, that they actually came up with something called as transfer pricing law? Can anyone tell me what was the problem? If you can quickly type it out, or if you can put it in the chat box, or if you can just unmute yourself. Why did they come up with transfer pricing? What was the problem? Okay. Anyone who'd like to unmute and talk about what was the problem? Why did they come up with transfer pricing? Okay, so we'll discuss what was the problem area for transfer pricing. Well, if you actually look at the amount of trade that actually happens throughout the entire world, which is more like global trade, so you'll see that significant amount of global trade. It's actually one third of the global trade. It actually happens between multinational enterprises. When I talk about global trade, it could be anything. It could be, purchase of goods, or it could be performance of services. It could be borrowings. It could be a transaction which is relating to intangibles, etc. It could be anything. But what I'm really trying to say is that one third of this world trade happens between multinational enterprises, and these are called as intra-group transactions. They are happening within a particular group, out there. So this could be a transaction. Let's say there is a parent company and it has a lot of subsidiaries. So it could be a transaction between the parent company or the subsidiary, or it could be a transaction between, two different subsidiaries of one entire group itself. So what is the problem with these intra-group transactions? Well, the problem is that if you actually look at independent transactions, and I'm also, talking about unrelated parties, I'm talking about two entities that are not related to each other. Let's say two enterprises that are independent of each other, they're not belonging to the same group, etc. When these two random enterprises or random companies in the market, when they transact between themselves, they transact at something called as an open market price. Now, what is this open market price? Well, a price which is driven by market forces, a price which is driven by, demand and supply. There is demand and supply that plays. So the price that is determined by that demand and supply, that is the open market price. So when we're talking about independent enterprises, they always transact at open market price. It's something like, when you talk about from the seller's perspective, the seller would always want to sell at the highest price possible. And when you look at it from the buyer's perspective, the buyer would always want to purchase something from the lowest price possible. So, between the seller and the buyer, they somehow interact and they come up to something, they negotiate and they come up to something called as an open market price. The problem is that when you actually talk about related parties, when you talk about intra-group transactions, or when you actually talk about parties that are associated to each other, they do not transact at an open market price. So what do they transact at? Well, they transact at a price which is coming from the relationship that exists between them. It differs from open market conditions. They transact at a price which is more like a combination of market forces and group driven factors. It's more like a common interest that they have between them, and this is the reason they manipulate the prices out there. But why do they manipulate the price? Well, they manipulate the price so as to indulge in something called as tax avoidance, so that there is tax avoidance, so that the price is not reflective of market conditions. This is the price that they actually transact at, and that helps them to get into tax avoidance strategies. So that is the problem with related party transactions. Let's take a simple, very, very simple example to discuss what I'm actually talking about. So we'll look at these two situations right here. This is the problem through the case study that I'm actually talking about. And this is what, we will be talking about. So we're talking about two situations here. If you look at the left side of your screen, there is situation one. And if you look at the right side of your screen, there is situation two. Situation one talks about independent parties, when transaction is happening between two entities not related to each other. And situation two talks about the same problem that happens between the same transaction that happens between related parties. In a while, I will tell you the terminologies I've mentioned here, which is uncontrolled transaction and controlled transaction. But let's look at situation one here, which is the left side of your screen that you need to focus on. Now, there is a company in India right here. And this company in India is, let's say, a manufacturer. It is manufacturing, let's say, pens. And what it's actually doing is it's manufacturing pens and it's selling to an overseas company, which is obviously not in India. So that's the transaction. Now, the cost for manufacturing this pen by the company in India, which is the manufacturer, is 60 units, 60 rupees, let's say. The sales out here is 120. So, this is the open market price. The seller, which is the company in India, is selling to the overseas company at 120 rupees. The profit obviously comes to 60 rupees. Let's say that the tax is at the rate of 30%. So the tax comes to 18 rupees. So this is the tax burden from the Indian company's perspective, which is 18 rupees. Now we look at the same transaction, but we change it to related parties. So the only difference right here is that this company in India and this overseas company are now related to each other. How related? Well, let's say that this company in India is a parent company and it is actually, selling to the overseas subsidiary. So this overseas company now becomes its subsidiary, and a parent company and subsidiary company would be associated or related to each other. From an Indian perspective, from transfer pricing perspective also, we have a specific definition to how two companies become related or associated to each other. We'll discuss that. But for now, it's just important to know that this parent company and this subsidiary are, now related to each other. So now everything remains the same. And there is a reason that I'm actually saying that everything remains the same. I will talk to you about that in a while, but everything remains the same as in situation one. The only change is that now the entities are related to each other. So now also the cost of manufacturing the pens is 60 rupees. But now sales happen not at 120, but they happen at 80 rupees. Can you tell me why have they decided to make sales happen at 80 rupees? Why sales is now happening at 80 rupees? Can you tell me? Can anyone put it on the chat tab? Where have they derived this 80 rupees from? How 80 rupees? That's the question. Okay, that's absolutely correct. So there's an answer out here which says, to reduce tax. That's absolutely correct. But how will they reduce the tax? Well, this is how they'll reduce the tax. What they did was they actually sold to their related party at 80 rupees, at not at market price. The market price was 120, but they decided that because we are related parties, because we can manipulate the transfer price, there is no regulation out here that is regulating us right now. So they decided that let's just transact at a price which is driven by our relationship, which is the parent company and the subsidiary company, rather than at a price which is the open market price. So this is what I've mentioned here. They are driven by a price which is group driven forces determined. So this is the reason they transacted at 80 rupees, just any random price they transacted at. What was the effect? The effect was that profit came down to 20 rupees. Tax is at the rate of 30% itself. So tax becomes 6 rupees. Tax at the rate of 20 rupees, it becomes 6 rupees right here. So do you see how by transacting within the group, they were able to bring down the tax to 6 rupees from 18 rupees because they transacted at a random price, which is 80 rupees, and they did not transact at the market price out there. So this is the reason that there is always a possibility that two or more entities within a particular multinational group, they can fix up their prices. And this is the reason, and this is the way that they actually avoid taxes right here. They avoided tax by 12 rupees by not transacting at the open market price. But you might be wondering, Kriti, you've explained, from the Indian company's perspective, maybe it actually balances out at the overseas, level. Well, let's take another example to tell you how and if it actually balances out or not. So now this particular case study, we will discuss it from two companies' angle. Okay, we'll discuss it from the company that sells and also from the company that actually purchases it. And let's see if there is any problem that actually occurs in this particular situation or not. This is where, but any problem with this particular case study right now? You can put it on the chat tab. Any problem, or shall I just continue? Also, if you feel that I'm very, very fast, you can just tell me right now. Okay. Shall I just continue? If you can just put it on the chat tab. Okay. Uh, Also a question, income can be only 60 instead of 80. Uh, well, out here you can do anything. If you're talking about, the sales figure out there, well, it could be anything. It could have been 100, it could have been 70, it could have been 60. It was actually just dependent on what related parties, determine. So it's not dependent on anything. It's not dependent on open market conditions. It's just dependent on what related parties actually think, and this is the reason that they actually fix it at 80. Now, the concern is, do you think in a related party situation the cost will change, like the 60 rupees will change? Well, the answer is that no, 60 rupees will never change. Can you tell me why 60 rupees remains constant here in independent party situation, and it remains constant here as well in related party situation? Why aren't they? Because this is a related party situation. Why did they not change 60 rupees out here? Why can't 60 rupees change? Because of the manufacturing expenses. Okay. Any other reason? Any other? Well, the 60 rupees do not change because 60 rupees is not a transaction between related parties. Imagine I am a manufacturer, okay? I am purchasing raw materials from a third party. So in this particular situation also, this parent company is actually purchasing raw materials from a third party with which they are not related at all. Now, why would a third party decide to actually change, the prices? The third party will never agree to manipulate, the prices out there. If the third party is selling in this situation, if the third party is selling to the Indian company at 60 rupees, the third party in this particular situation also will sell to the related party at 60 rupees. They will never manipulate their prices because this is a third party transaction. But prices were manipulated at this level between the parent company and the subsidiary company because this was a related party transaction. In a related party transaction, there could be, price manipulation, but never in a third party, transaction. This is the reason that, the cost price remains the same at 60 rupees. But what was actually, manipulated was the sales price, which was 80 rupees. So this is the reason there was a problem out here. Another question out here, but they may inflate the cost also to bring down the tax in related party transaction. Yes, that's absolutely correct. You're absolutely correct in saying that they might actually make changes to the cost also. But you have to make sure that in that situation, the cost, the transaction relating to cost is actually a related party transaction. As long as that is the situation, yes, they can absolutely inflate the cost to bring the tax down. That's absolutely fine. So what I'm really trying to say is that price manipulation can happen in a lot of ways. It could be, by bringing the sales down. It could be by, putting the cost up. It could be anything, as long as the related party transaction is a manipulated price. The transfer price, as in the price at which the related parties are transacting, it's actually manipulated. Then there could be tax avoidance that can actually happen. And to address your, query, this is the reason I, look at this particular particular case study right here. So now let's look at this case study to see how price manipulation can happen again. Let's say that there is a company which is called as company F, and this company F is an Indian company. Okay. The tax rate in India, we're presuming, is 30%. Now, how the transaction flows is that this F company sells to a Singapore company, which is company I. The tax rate in Singapore is 17%. Now, company F is the manufacturer. It sells the commodity to company I in Singapore, and company I sells the commodity to a third party customer. So this is how the transaction actually flows. Company F sells to company I sells to third party customers. Now let's say that company F and company I are not related to each other. They are independent parties. When they are independent parties, obviously they will transact at something called as open market price. So for our purposes, let's look at the black font here. Don't look at the red font. Just look at the black, font here. So let's say that company F, which is the Indian company, is manufacturing the commodity at $1,200. Okay. So the cost price is 1,200 and it actually decides to sell the commodity at $1,400. So the profit for the Indian company is $200. So I mentioned it here that Indian company, the profit for the Indian company is $200. What is the tax rate in India? It is 30%. So tax becomes $60 in India. Now, what happens is that this company sells the commodity to company I in Singapore. So what is the sales price? It was $1,400. So company F sells to company I at $1,400, which obviously becomes the purchase price for company I. So company I purchased it at $1,400. Now, company I also had put in some value addition. They also incurred some cost out there, and they incurred a cost of $100 in, let's say, beautifying the product, further. So they incurred $100 out here. And finally, they sold the commodity to the third party customer at $1,600. So what is the profit in Singapore? It's 1,600 minus 1,400 minus 100. That actually gives us a profit of $100 in Singapore. So a profit of $100 in Singapore. What is the tax in Singapore? It is 17%. So $17 on $100, and that becomes $17. Now, if you look at through this particular transaction, if you actually look at the tax burden for company F and company I put together, it is going to be $77. How? Well, $60 of tax that company F paid in India and $17 of tax that they paid in Singapore. So it is $77. Now, let's turn around the situation. Now, let's say that company F and company I, they are now related to each other. They are now associated to each other. It could be anything. Let's say that, company F is the parent company and company I is now the subsidiary company. So they are related to each other. They're part of the same multinational group. Now for this purpose, we will focus on the red font out here. Now, when company F is related to the company, the cost again is $1,200. Why will the cost not change? Because this is a third party cost. Company F is actually paying this cost to a third party, raw material supplier. The raw material supplier is not related, so they will never, change the cost. They will say that, I don't really care whatever you're actually selling it to, whether you're selling to independent party, whether you're selling to related party. I don't care. I will sell at $1,200, which is the open market price. So the cost here is $1,200. Now they have to sell the good to company I. Company F and company I are now related to each other. They decide that I'm not going to sell at $1,400, which is the market price. I will sell at maybe, $1,300. Where is $1,300 coming from? Well, I can't really say. it's coming from, group driven factors. It's just how they decide. It's just, like a decision between company F and company I, and it's not reflective of market conditions. So they decide that I will sell at $1,300. So the profit in India becomes $100. 1,300 less 1,200. The profit in India is $100. Tax in India is 30%, so $30 right here. Now this product goes to company I. Company I purchases it for $1,300. They have a cost of $100 and they decide to sell the commodity to third party customer at $1,600. Now, $1,600 will also not change. Why? Because this is a transaction to third party customer. If you tell the third party customer that, listen, I'm going to sell it to you at $1,700 now, they will not agree. The third party will never, say yes. They will go to someone else and buy the commodity from someone else. But this is the reason you cannot manipulate this third party price, which is $1,600. So this remains $1,600. They purchased the commodity at $1,300. Cost is $100, and now the profit in Singapore is $200. So $200 of profit in Singapore, tax at the rate of 17%, which makes it $34 in Singapore. So now if you look at the entire transaction, for the group itself, they have paid $30 of profit of tax in India, and they have paid $34 of tax in Singapore. So the total tax that they have actually paid is $64 out there. And this exactly is something called as tax avoidance strategy. By manipulating the transfer price, by not selling at 1,400, but selling a particular commodity at 1,300, they were able to bring down their tax for the group by $13 out there. $13 obviously sounding, very small right now, but obviously the transactions are big. So what I'm really trying to say is that there is always a group tax savings. This is the tax avoidance that they were able to make by selling at a price which is not market price, which is just a price between, the two companies out there. So this happened because of something called as mispricing, because of something called as incorrect pricing. This kind of, tax saving actually happened. Another thing that I've actually wanted, any questions here? And I will also talk about one more thing. Any questions here? Okay. Okay. So another thing that I want to talk about here is you must have heard of something called as BEPS, which is base erosion and profit shifting. What is profit shifting? Well, it says shifting of profits from high tax jurisdiction to a low tax jurisdiction. Like you're moving profits. Okay. What is the high tax jurisdiction here? It's India, which is 30%. What is low tax jurisdiction? It is Singapore, which is 17%. So what they've done is by manipulating the prices, which is instead of 1,400 selling at 1,300, by manipulating the prices, they shifted the profit also from India to Singapore. How? The profit initially in India was 200. But now it is actually $100 only. So what have they done to the $100 of profit? They have moved it to Singapore. And now in Singapore, the profit is $200 instead of $100. So what they've done is, because India was a high tax jurisdiction, they moved $100 of profit from India to a low tax jurisdiction like Singapore. And because of this, they were able to have a group tax saving also. So this precisely is called as shifting of profits from a high tax jurisdiction to a low tax jurisdiction. How was all this possible? How was, tax avoidance possible? How was shifting of profits, possible? it was only possible because of something called as mispricing, because of unjustified pricing, because they moved the transfer price out here from $1,400 to $1,300. And this precisely is obviously a part of BEPS also, base erosion and profit shifting. Any questions here? I'm sure everyone knows about, BEPS. Okay, any questions? Okay, shall I move on? Okay, yes, you should move on. Okay, thank you. So yes, so this is the reason, because there were so many problems that was happening because of these related party transactions. And I told you that related party transactions, there are about 30% of the world transactions were related party transactions. They obviously had to do something so that this does not happen. And this is where we have transfer pricing come in. So what is transfer pricing? Well, transfer pricing is an anti-tax avoidance law. Transfer pricing is not like corporate tax rate at the rate of 25%, 30%. It's not like equalization levy at the rate of 22%, 6%, whatever. It's not like it's not like a tax. It's not like a percentage out there. But transfer pricing is actually a law. What kind of law? It is an anti-tax avoidance law. Transfer pricing law or transfer pricing regulations, they actually came in just to make sure that these tax avoidance strategies, they do not happen. And this is the reason transfer pricing is called as anti avoidance law, or we can also call it anti tax avoidance law. So, the meaning of transfer pricing is coming from the United Nations manual, the UN manual on transfer pricing. And it says transfer pricing is just the general term for the pricing of cross border intra-firm transactions between related parties. So, it's more like a general term. Whenever there is a cross border transaction, was this cross border? Yes, because this is a company in India and this was an overseas subsidiary. So, whenever there is a cross border transaction, there is an intra-group transaction. Is this between a single group? Yes, this is between the multinational group itself. So, whenever there is a cross border, intra-firm or intra-group transactions between related parties, that is where transfer pricing comes into place. And what does transfer pricing do? It talks about setting of prices at which these transactions should happen. So transfer pricing will be applicable in situation 2 because this is a related party transaction. It is an overseas or a cross border transaction, and transfer pricing law will precisely tell them that listen, you should not transact at 80 rupees, you should transact at an open market price. What is open market price we'll discuss in a while, but this is where transfer pricing will be applicable, and they will tell them that listen, don't transact at 80 rupees, transact at some other price. So that is the something called as transfer pricing law. In any case, if they have transacted at 80 rupees, there will be a transfer pricing adjustment by the tax authorities. We'll talk about that also. It's a little technical as a concept, and this will be discussed, I think, in the 4th lecture or the 5th lecture, what is transfer pricing adjustment, but that is what will be applicable, out here. So transfer pricing will be applicable in this particular situation, and that is what I have, mentioned at this particular slide. So to give you a very, very precise definition to what is transfer pricing, well, it is just a law to prescribe at what price should related parties transact. Should they transact at 80 rupees? Should they transact at 60 rupees? Should they transact at 100 rupees or 120 rupees or 150 rupees? What should they transact at? That is the law that will prescribe that. So that is transfer pricing law. Now, when it comes to transfer pricing, there are two manuals, that we will be following. If you look at your, chapter on transfer pricing, it might just mention about the OECD transfer pricing guidelines, and it might just mention about the UN transfer pricing guidelines also. So now these are two manuals and these are two guidelines that we have: OECD transfer pricing guidelines, and then there are United Nations UN, transfer pricing guidelines. I have put in a link for these two, out here, so you can, just rely on that. My only concern is that you might have also discussed and about something called as OECD Model Tax Convention, OECD Double Taxation Convention, OECD Model Taxation Convention on Income and on Capital. That is what it is called. So don't get confused between the two. That is the OECD Model Taxation Convention, where all the articles are written. Article 1, Article 2, Article 4 residence, Article 5 permanent establishments, etc. All the articles are provided there. That is OECD Model Taxation Convention. When double taxation arises, you rely on that. And then there is OECD transfer pricing guidelines. These are very specific to transfer pricing. They will say what is arm's length principle, what is the problem, why transfer pricing came in, and everything that we discuss going forward is provided in OECD transfer pricing guidelines. Similarly, for UN also, there is United Nations Model Double Taxation Convention, and then there is UN transfer pricing guidelines. So, don't get confused. For the purposes of transfer pricing, we'll be relying on transfer pricing guidelines. Apart from these also, there are other forums also. There is, European Union Joint Transfer Pricing Forum. So EU has their transfer pricing guidelines. Then there are transfer pricing guidelines in US also, in Australia also, etc. But these are the two that are actually generally, followed. Now, that India is not a member of the OECD. So, we rely on UN transfer pricing guidelines. But then, obviously there are case laws out there where courts have actually used OECD transfer pricing guidelines also. You don't have to necessarily get into details of what these two manuals are, but you should just know, because the chapter will be talking about OECD transfer pricing guidelines. So I don't want you to get confused between OECD Model Taxation Convention and OECD Transfer Pricing Guidelines. So you should just know that these, exist, and this is what, is actually relied upon. Now, what we have are, some key terms that are used in transfer pricing. If you open your chapter on transfer pricing, it does not define all these key terms, but I want you to know these key terms because they will be used throughout the chapter. And if you don't know the meaning of these basic terms, it will be very confusing out there. This is the reason I thought I'll talk to you about these key terms, also. So the first key term that I will be talking about, the first terminology, is something called as controlled transaction. What is a controlled transaction? Controlled transaction is just a fancy term. It basically means a transaction between related parties. When they want to call a related party transaction, for transfer pricing, they say controlled transaction. Why? Why are they doing that? Why are they making it so confusing? Well, the term controlled transaction means that parties are subject to the control or influence of the related parties involved. So in this situation 2, this is going to be called as a controlled transaction. Why controlled transaction? It basically means that these two parties are transacting at the control, or they are at the influence of each other. This is the reason they are called as controlled transactions. Now, these transactions could be, anything. It could be a transaction for sale of, goods or sale of services. It could be, an intangible transaction. It could be a loan transaction. As long as it is between related parties, this sale of goods between related parties, this transfer of intangible between related parties, this loan transaction between related parties, or management services between related parties, as long as these transactions are between related parties, they will be called as controlled transactions. And the second terminology that you will see is something called as uncontrolled transaction. Uncontrolled transaction in transfer pricing basically means that it's a transaction between two independent parties. They're not related to each other. There is no relationship between the parties, and there is no possibility that one party can influence the other party. There is no control, there is no influence out there. And this is the reason these are called as uncontrolled transaction. So whenever there is a transaction between two independent parties or two unrelated parties, we call them uncontrolled transaction. This is the reason this transaction, this situation one, is called as uncontrolled transaction out here. This is uncontrolled transaction. Okay. So this is the difference, uncontrolled transaction and controlled transactions. Right now, it might just sound very, difficult to absorb what is controlled and what is uncontrolled. It's a little confusing, I know, but we will be using these terminologies very, very frequently through the entire chapter. So it'll become, easier. Just remember controlled as in there is control out here. So related party transaction, and uncontrolled, no control out here, independent party transaction. Okay. Any question till now? Any questions? Okay. So now we say, sorry. Okay, thank you so much. So now we start with the application of transfer pricing law. Where is transfer pricing applicable? I have a question right here. Word control is already mentioned in India as 110 and other AS also, accounting standard also. The point is that this word control is not defined for the purposes of transfer pricing. This is one instance where we have discussed control. I will also be talking about this terminology here also, participation through control. And we will be talking about this terminology a lot, going forward. Control right here also. I will talk about, how it is defined, if it is defined, and all these things. So, just allow me some time to, get there. But for transfer pricing purposes, just to break the ice, no, the word control is not defined. We'll talk about that. Now, this is where we'll start with application of transfer pricing law. So, the moment we know that we are talking about situation two, you know that there will be transfer pricing that will be applicable here. Why? Why will it be applicable here? Because this is a transaction between related parties. Now, if it is a transaction between related parties, going forward, we will start calling related parties as associated entities. This is a terminology that we use for, transfer pricing purposes. So we'll call it, associated entities. Is there a transfer of property or services? Yes, there is a transfer of property, as in there is a sale transaction out here. Is it a cross-border transaction? Yes, this was a cross-border transaction because the parent company was in India and the subsidiary was an overseas, subsidiary out here. So, will transfer pricing be applicable? Yes, transfer pricing will be applicable. Going forward, we will also be calling cross-border transaction as international transaction. This is just a terminology that we use in transfer pricing. So when all these conditions are satisfied, transfer pricing will be applicable. And when transfer pricing is applicable, transfer pricing law will say that you will not transact at 80 rupees. You should transact at something called as arm's length price. So that is something called as arm's length price. So transfer pricing will be applicable here. Transfer pricing will say that don't transact at 80 rupees, transact at something called as arm's length price. What is this arm's length price? Well, now we will be spending entire time to just discuss what is arm's length price. There are these, obviously there is a definition that I will be talking about of arm's length price. And then there are these six methods in India to calculate the arm's length price. It could be 120, it could be 150, it could be 60, but there are methods to do that, and we will be, discussing that. So this is the reason I've mentioned here that an international transaction between associated entities needs to be at something called as arm's length price. Now, if you look at transfer pricing, generally it is an international tax concept. When I say international tax concept, because there are international transactions involved. Uh, but in India, we also have transfer pricing impact domestically. So transfer pricing in India is also applicable on two domestic entities out here. And that concept is called as specified domestic transaction. It is also called as SDTs. We will be talking about that, after some time. First, we'll, just be talking about international, tax concept, which is, the international form of transfer pricing. I will be talking about specified domestic transactions, but, later on. So this is what we're arrived at, that it should be at something called as arm's length price. What is arm's length price? Well, arm's length price means what is the price at which independent parties are transacting at. It's more like mimicking international parties, independent parties. It's more like, in this particular situation, we clearly know that 80 rupees is not, the arm's length price. It is just a manipulated price. It is not the price at which related parties should have transacted. So what should it be? Well, it should be arm's length price. What is arm's length price? Look at independent parties. Can you find independent parties which are operating in comparable circumstances? Yes, I do see this situation one, which is a transaction between independent parties. What is the price at which independent parties are transacting at? Well, they are transacting at 120. Well, that's something called as arm's length price. So, what is the arm's length price? It means a price which is applied, or it is proposed to be applied in a transaction between persons other than associated enterprises in uncontrolled conditions. That is, uncontrolled transactions. What were uncontrolled transactions? They were independent party transactions. So what you have to do is you just have to find out independent enterprises. What is the price at which independent parties are transacting at? Well, that is something called as the arm's length price. So in this situation, they should not have transacted at 80 rupees. They should have transacted at 120 rupees because that's the arm's length price. But it's not that simple. Now, for 120 rupees to be the arm's length price, it says that it should be comparable. As in, these two situations should be comparable. If you're talking about, manufacturing here, this should also be manufacturing. If you're talking about India and USA here, this should also be India and USA. If you're talking about pens as a transaction here, transaction should also be talking about pens, and it should not be talking about pencils out here. So this is the reason that these two transactions should be comparable transactions. Only then you can take 120 rupees as the arm's length price. So that is something called as the arm's length price. But obviously, there are a lot of things out here. There is something called as, comparable. What is the meaning of this term comparable? I will be talking about that here, the comparability out here. If I said that this is so easy to calculate 120 rupees, why do we have these six methods? Well, that is because there could be, some transactions like intangible transaction, or there could be some transactions for which a comparable transaction is just not possible. You can't find an independent party which is operating in comparable situations. What do you do then? Well, for that reason, we have a lot of methods in India for the purposes of calculating the arm's length price, and we will be talking about those as well. So this is the meaning of the term arm's length price. Any questions? this is an important concept because going forward, all through we will be talking about calculating arm's length price or using arm's length price, and we will be using this terminology, very, very frequently. So if you have questions, you can just let me know right now, and we can proceed accordingly. Okay. Else you can take a minute and just read through this, because it's very important that you should know what this slide actually talks about. Question right here, are there similar provisions in other countries also? Yes, there are provisions in other countries also. Every country, oh, well, most of the country, they have their own, transfer pricing law. India has its own transfer pricing law, which is Section 92 right now of the Indian Income Tax Act 1961. Most of the nations have transfer pricing law. Dubai very, very lately has introduced, its transfer pricing law. So yes, most nations have their own, transfer pricing law. When we go forward, I will, just tell you about, more about other nations also. I'd be happy to do that. And give you a comparative analysis of where India differs from other countries. But yeah, every nation has transfer pricing law. There are still nations around the world that do not have a transfer pricing law expressly, but most of them have it. Okay. So where is this arm's length price coming in from? Well, this arm's length price is coming from something called as the arm's length principle. What is arm's length principle? It's just a principle. It's just a standard which is used in transfer pricing. And this is the international consensus on transfer pricing. It just makes sure that there is no tax avoidance. Profits are not artificially shifted between related companies. Where is this arm's length principle coming in from? Well, it's coming in from Article 9 of the OECD Model Taxation Convention. I'm sure you've read this Article 9 of the Model Taxation Convention. This is associated enterprises. And I will be talking about this particular article, now. But before that, this is a little technical. Let's take a short break right here. Let's take about 10 minutes of break, and I will come back and discuss what exactly is Article 9, where is arm's length price, coming in from. So let's take a break and I will come back and discuss this. If you have any questions meanwhile through the break, also just put it on the chat tab. you. Okay, so we were discussing where is this arm's length price coming in from? Well, as I mentioned, this arm's length price is coming from something called as arm's length principle. What is arm's length principle? It's the international consensus on transfer pricing. Why say that this is international consensus? Well, that is because, if you see nations around the world, as I mentioned, most of the nations around the world, they have transfer pricing law. And when they talk about transfer pricing law, all of them have adopted something called as the arm's length price. In India also, if you actually look at Section 92 of India's Income Tax Act, which is out here, Section 92, you will see mention of something called as arm's length price. They will say that, when you have international transactions between related parties, they should transact at arm's length price. So this is the reason this is called as international consensus on transfer pricing. And this is coming from Article 9, which is Associated Enterprises, but of OECD Model Taxation Convention. Now remember, Model Taxation Convention, not the transfer pricing manual, because this is where it's derived from. So now if you just read through this, it says, where conditions are made or imposed between two associated enterprises in their commercial or financial relations, which differ from those which would be made between independent enterprises, then any profits which would, but for those conditions, have accrued to one of the enterprises, but by reason of those conditions have not so accrued, may be included in the profits of that enterprise and taxed accordingly. What is this? Well, this was, honestly, my reaction also when I read this for the first time. But read it again. Can anyone explain this? Can anyone just make a try? Try explaining this. Read it again and maybe it will make more sense. Anyone who can explain this? I know it's very technical. Okay. Any hints? Okay. So let me try explaining you this complex, statement. This statement says that, when two independent enterprises, when they transact between themselves, there are always, commercial and financial relations. What are these commercial and financial relations? These commercial and financial relations are, what is the price of the good? What are the conditions for transfer? That, what is the credit period, what is the price of the good, how will you make delivery, will you make delivery of goods, etc. There are always, what I'm trying to say is that commercial and financial relations between independent enterprises. But then the thing is that when associated enterprises, when they transact between themselves, these commercial and financial relations, either they are absent or they're very, very, different. So when related parties, they transact, the credit period is not the same like independent parties. When independent parties transact, they will say that, we'll have a credit period of, let's say, 90 days. But when related parties transact, related parties might say that, let's have a credit period of 120 days, not 90 days. So they have commercial or financial relations, but they are not like independent parties. They are very, very different. And if because of that difference, there is a price manipulation, well, that is where transfer pricing will be applicable. So this principle tries to say that these two situations should be the same. But because these two situations are not same, because of that, if there is a change in profit, so in this situation, the profit is 60 rupees. And in this situation, there is a profit of 20 rupees. Why is there a difference in profit? Well, that is because there is, related party manipulation that is applicable here. So this principle says that if this is the situation, what we'll do is we'll add back the profit to this situation and then we will tax it accordingly. So what they'll actually do, how much do you think they'll add back here in this situation? How much profit will they add back here in this situation? Very quickly, can you type it? 40. Yes, that's absolutely correct. They will add back 40 here and then they will tax it accordingly. So what they'll do is, as I mentioned here, any profits which should be accrued but is not accrued may be included in the profit of that enterprise and then taxed accordingly. So what they'll do is they'll add back 40 rupees here and then they will tax this related party at 60 rupees. So this is called as transfer pricing adjustment. This adding back of 40 rupees is done by the tax authorities and this is called as transfer pricing adjustment. So where is this coming from? This is coming from Article 9 of the OECD Model Taxation Convention. Now, when you look at the chapter on transfer pricing from the institute, you will see that there are significance of arm's length principle, which is actually mentioned here. There are quite a few significance, quite a few reasons why arm's length principle is or should be applicable. The first one is that there should be parity between multinational enterprises and independent enterprises, in the sense that if there is the same thing between multinational enterprises and independent enterprises, it helps in avoiding tax advantages and disadvantages. This is the reason they associated enterprises and independent enterprises, they should be kept on an equal footing. And then it helps in determining the real taxable profits. This is because of the arm's length price. So now, if they do not have arm's length principle applicable here, this profit is not the real profit out there. This 20 rupees of profit is not the real profit. But when you have transfer pricing applicable here, this is the real profit which will be applicable, which is 60 rupees, right here. So this is the reason arm's length principle should be, applied. It helps in reduction of artificial price distortion. So if arm's length principle is not followed, there will be shifting of profits from high tax jurisdiction to low tax jurisdiction. This is what you actually saw in this particular slide also. Arm's length principle was not followed. They transacted at 1300 rupees. Hence there was shifting of profits, and hence there was tax avoidance that was actually applicable. Accurate measurement of economic contribution, well, it helps in providing accurate measurement because everything they now transact at fair market price or they transact at open market price if the arm's length principle is followed. So this is just a little bit of theoretical stuff which is provided in the transfer pricing chapter. But if you've understood the concept, really, if you've understood these two case studies, this theoretical concept, should make a lot of sense. This one, okay? So this was the arm's length principle. This is the significance of arm's length principle. Now we have something called as comparability factors in transfer pricing. The manual just lists down the comparability factors. It just says that, these are the comparability factors. But then I thought, I'll just describe them in a little more detail. So you don't have to get into a lot of details with respect to comparability factors, but you should just know a little bit because this will help us, going forward. Now, when it comes to comparability factors, why are we discussing them? Well, we're discussing them because when we actually moved to this slide, I said that you can adopt 120 as the arm's length price because this is a price between independent parties, but make sure that these two transactions are comparable. So are there some factors that will help you in assessing comparability? Well, yes, there are some comparability factors. There are these 5 comparability factors, and you will have to make sure that these 5 comparability factors are ticked. They are in both situations, and only if they are replicating each other, only then you can take 120 as the arm's length price as an example. If you feel that independent party situation is comparable on these 5 comparability factors to the related party, only then you can take that independent party price as the arm's length price. So what are these 5 comparability factors? Contractual terms of the transaction. something called as functional analysis. It's also called as FAR analysis, characteristics of property or services, economic circumstances, and business strategies. From a theoretical standpoint, from an examination point of view, I've seen questions being asked on what are the five comparability factors, in transfer pricing. So these are, the five factors that you have to list out there. Okay, so the first one is pretty simple. The first one is characteristics of property or services. This comparability factor is just saying that, listen, if you're comparing two transactions, just make sure that if this is talking about pens, this should also be talking about pens. So if you're talking about a tangible property, the tangible property should be the same. Physical features, the quality of the tangible property, should be the same. To some extent, they also say that, if you're talking about ballpoint pens here, just make sure that the related party is also talking about ballpoint pen. You cannot be comparing a ballpoint pen manufacturer to an ink pen manufacturer. Do you think there will be a price difference? Yes, there will be price difference between a ballpoint pen and an ink pen. This is the reason you cannot compare, those two, situations. So if you're talking about tangible property, it should be the same. If you're talking about services, let's say that this independent party is providing, let's say, information technology service. It's providing IT services, to the overseas company. Well, then you'll have to make sure that the related party is also providing IT services out there. It should not be that, this is an IT service provider and this is a BPO, a business process outsourcing, or a KPO out there, or they're providing, some other human resource management service, etc. No, if this is IT service, this should also be IT services. So characteristics of property or services should be the same. If you're talking about intangible property, then it should also be the same. So property or services, it should be, the same. The next thing is functions, assets, and risk analysis. This is also called as FAR analysis. Functions, assets, and risk analysis. This basically means that if you're talking about independent party, what is the function of independent party here, which is the Indian company? Well, its function is manufacturing. If this is a manufacturer, this should also be a manufacturer. It should not be that this company in India is a manufacturer and this parent company, for related party is a service provider. Then you cannot compare because there will be a price difference. So this should be a manufacturer. This should also be a manufacturer. So functions should be the same. Then the kind of risk that they assume should also be the same. If this is assuming a lot of risks in providing this transaction, this should also assume a lot of risk out there. Have you heard of this terminology? Higher the risk, higher the profits. That is the situation. If this is if this is assuming a high amount of risk, this should also be assuming a high amount of risk. So this is the reason functions, assets, and risks should be, the same. The third one is contractual terms. Contractual terms basically means that you should just make sure that if there is a contract between the associated enterprises, it should really be followed in reality. It should not be a sham transaction. You'll have to make sure that they actually follow what is written in the contract. A lot of times what happens is that this related party, they will make a contract, and they will have terms and conditions written out there. Now the terms and conditions in the contract will be like independent party, but then step 2 is, are these related parties actually following it? Are these related parties actually following what they've written in the contract? So this is what you'll have to make sure, that what they have written in the contract, which is like independent party, that is being followed, out there. So that is contractual terms. The fourth one is economic circumstances. In the fourth one, what we try to make sure is that if you're talking about independent party situation, which is India and USA, related party situation should also be India and USA. You cannot compare India USA transaction to an India China transaction. Why do you think that's not comparable? That kind of transaction? Why do you think we cannot compare these two transactions? Okay, due to PPP. Purchasing power parity, is that what you're talking about? Yes, okay. Yes. So, to give, your answer a wider perspective, these are more like economic circumstances. Because the economic circumstances are very different for an India-USA transaction to an India-China transaction. This is absolutely the reason why we cannot compare an India-US transaction to an India-China transaction, because the economic differences will be there. Going forward, I will tell you whether these transactions, maybe you can do some adjustments to make sure that these two transactions can be comparable. We'll talk about that. But right now, economic circumstances are important to be matched. Then what is important to be matched is the date and time of the transaction also. Let's say that they are talking about medicines or medical equipment, being manufactured. Now, if independent party is transacting in a pre-COVID time, you have to make sure that the related party was also transacting in a pre-COVID time. You cannot compare a pre-COVID transaction to a post-COVID transaction, because especially for the pharmaceutical sector, especially for the medical sector, a lot changed. So you cannot compare these two transactions. So you'll have to make sure that, the time and the date of the transaction is also, the same, because there are market fluctuations and there are so many fluctuations out there that the price of a commodity changes, on a daily basis. If you look at the price of silver, if you look at the price of commodities like gold, it changes, so frequently. So this is the reason, if you're comparing these two transactions, the if you're comparing these two transactions, the date and the time of the transaction should also be the same. And finally, there are business strategies. Business strategies basically say that you cannot basically compare a startup company to a well-established company. If you're talking about a startup company generally has a lot of losses. And what do startup companies do? To enter the market, they might reduce the price. They might, offer the product on, discount, or they might have some different strategies out there. So this is the reason startup companies, even if it's the same product, startup companies might have different price for the same product, and a well-established company will not, undertake those kind of, strategies out there. This is the reason business strategies have to be the same. You cannot compare a startup company to a well-established company. So if these five factors are comparable, if these five factors that I mentioned are, matching in both the situations, the product is the same, contractually they are the same, economic circumstances are the same, FAR analysis is, the same, and business strategies are the same. Only if these five things are comparable, yes, you can take 120 as the as the arm's length price, and you can copy paste 120 out here as well. So that is basically the arm's length price. I know that's very difficult. How do you establish? Where will you find that company where all these five things are, matching? Well, that is the reason we have some methods out there. But preliminary, this is what you need to, remember right now, that these are the five comparability factors right here. And, this is something which is there in India. This is something which is written in the OECD transfer pricing manual. This is something which is written in the UN transfer pricing manual. And most of the nations also follow these five comparability factors. So this is something which is not specific to India, but world over, whosoever is following transfer pricing basis OECD and UN manual, they will look at these five comparability factors. So yes. Any questions now? Any questions? Otherwise, we will move to transfer pricing from an Indian perspective now. Okay. Now we have the domestic law framework. What is the structure of transfer pricing provisions, in India? Can you guesswork when did transfer pricing come in India? Which year? Year was transfer pricing introduced in India? Okay, guesswork. Okay. So it was 2001 when transfer pricing was actually introduced in India. The then finance minister made a speech, and it actually talked about the rationale for introducing transfer pricing, regulations. They basically said that, the issue of transfer pricing was a serious concern because, intra-group transactions, they were controlling prices, and they were allocating profits to different jurisdictions, etc. And this is the reason they had set up an expert group in November 1999 to examine these particular issues. And this is the reason in 2001 they introduced transfer pricing in India. There are also nations where transfer pricing was introduced much, much before India. But in India, it was introduced in 2001. And there are also nations around the world where transfer pricing law was issued or was introduced in the year 2022, 2023, 2024 also. So, yes. So it was the Finance Act of 2001 that actually came up with Chapter 10, which talks about special provisions relating to avoidance of tax. So if you read through Chapter 10, that actually contains the transfer pricing code. It contains and it includes sections 92 to 92F that talks about transfer pricing regulations. It is Rule 10A to 10E of the income tax rules that we will be, discussing. Primarily, we will be discussing sections 92 to 92F of Income Tax Act 1961. Now that the provisions now that the 2025 Act is also coming up, but we will be restricting it to 1961. So section 92 to 92F is what is relevant, for you. So this is chapter 10, which says special provisions relating to avoidance of tax. Can someone tell me why have they named chapter 10 as special provisions relating to avoidance of tax? Why did they not say chapter 10 transfer pricing? Why special provisions relating to avoidance of tax? Can someone guesswork? Why not say chapter 10 transfer pricing? Why say chapter 10 special provisions relating to avoidance of tax? Anyone? Okay, can someone tell me what are general anti-avoidance rules? Anyone who knows what are general anti-avoidance rules? GAR. Can someone tell me what is GAR? Can you type it down? There is a kind of agreement which is there in GAR. Can you type it down? Can you type down the name of the agreement? Okay. Have you heard of something called as impermissible avoidance agreements? Okay. So, when you look at GAR in India, when you look at general anti-avoidance rules, they basically say that, whenever the tax authorities, they find out that there are some transactions which are impermissible, as in where the main reasons that they have undertaken that transaction is tax avoidance, the tax authorities may disregard those particular transactions. Those are called as impermissible avoidance agreements, and that is the concept is called as general anti-avoidance rules. So whenever the tax authorities they find out that a transaction generally is the main purpose is avoidance of tax, they will disregard it. So those are GAR rules. If you look at transfer pricing, these are special provisions relating to avoidance of tax. So transfer pricing is sometimes also referred to as SAR, as in special anti-avoidance rules. These are special anti-avoidance rules because in these particular situations, they are specifically targeted to related party situations. These are applicable when there is tax avoidance, but tax avoidance happens because of special reasons like related party transactions. So these are special provisions relating to avoidance of tax. This is the reason chapter 10 says special provisions relating to avoidance of tax, and they do not really call it transfer pricing specifically. This is the reason they're called as SAR. Now, if you look at chapter 10, there is section 92, which is, the charging section, which basically says that even when there is international transaction, it has to be computed with respect to arm's length price. So in India also, we follow something called as arm's length price. Then there is section 92A, which talks about AEs, as in associated enterprises. So what will happen that two entities will become associated to each other? That is what is mentioned here. Then there is section 92B, which is international transaction meaning. 92BA is specified domestic transactions. I mentioned that transfer pricing is applicable domestically also. So that is specified domestic transaction. Then we'll discuss section 92C, which is called as the arm's length price, which is basically the methods of computation of arm's length price. As I mentioned, there are 6 methods which are there in India to compute the arm's length price. We'll discuss that. Then there is section 92D, which is compliance, which is the documentation. And you must have heard of something called as Form 3CEB, or very, very casually, they call it transfer pricing return. Don't call it transfer pricing return. It's called accountant's report under the Income Tax Act. So that is section 92D and 92E. And then 92F has, some definitions that we will be reading upon. So these are, this is the flow that we've been, dealing with for this lecture and the next lecture. One thing that I can say is that when it comes to section 92A, 92B, all these particular sections, these sections that I've highlighted, they're important from an examination point of view. And they are also something that you should, know if you want to learn transfer pricing. This is, the basics in transfer pricing, the bare minimum that you should know for transfer pricing to be, applicable. So this is what we will be, discussing going forward. Any questions? So this is Rule 10B, which is determination of arm's length price. Then there is Rule 10C, D, and E that we will be, discussing. So these are relevant rules pertaining to transfer pricing. Very quickly, this is section 92, which basically says that whenever there is an international transaction and there is an income, it should be computed with respect to arm's length price. So what is the objective? The objective is to protect the tax base of India, just to make sure that there is no tax avoidance strategy out there. This is the reason they've introduced transfer pricing, and it's introduced with respect to section 92 of India's Income Tax Act. What is relevant is section 92A, which is associated enterprises, the meaning of associated enterprises. Now, this is the section which says that what should happen that two parties become related to each other or they become associated to each other. As I mentioned here, I said that this is a parent company and this is a subsidiary company, and they are related to each other or they're associated to each other. Is there a definition in India? Yes, there is a definition in India. This definition or these parameters will tell you that what is the threshold out there by which two enterprises will become associated to each other. So this is section 92A of India's Income Tax Act 1961 that we will start with. But before that, because this is now going to get a little more technical, what we discussed till now was very, very, generic. Now I'll become more technical. Any questions, till now? If you have feedback to share, this is for day one because this is the first time that we guys are meeting. So I thought I'll, just check with you on a generic feedback also. Any feedback? If this is going way too fast or this is going way too slow. Um, so I can adjust accordingly for the rest of the lectures as well. Or if you have any questions till now, if you can just quickly put it on the chat tab and I will continue. Okay, nothing. Okay, okay, thank you so much. That's very nice to hear. Okay, so we'll start with associated enterprises. And this is Section 92A, as I mentioned, of the Income Tax Act. Now, when you actually look at Section 92A, it's divided into two parts, obviously subsections. There is one, and then there is Section 92A2. So there is Section 92A1, and then there is Section 92A2. What does one say? One is something which is very, very generic. It's just giving like a general definition on how can two enterprises become associated to each other. So this one says that if one enterprise participates in the management, control, or capital of the other enterprise, then these two enterprises will become associated to each other. What is this? What is management, control, and capital? Well, the thing is that they have not defined what is management, what is capital, what is control. It's not defined for the purposes of transfer pricing. And even otherwise, what courts have actually done is rely on other laws. They've relied on SEBI to identify what is the meaning of control. They've looked at Companies Act to identify what is the meaning of management, capital, etc. They've relied on other judicial decisions to understand what is the meaning of capital, management, and control. But these are not defined terms for the purposes of transfer pricing law. So it just says, this is a very, very generic section. It just says that, let's say that there is company A. Company A is participating in the management, control, and capital of company B. Well, then company A and company B will become associated to each other. And the moment they become associated, well, they will have to transact at arm's length price because transfer pricing law will be applicable onto them. And obviously, they'll have to do all the compliances also, in India. So that is what is meant by that is what they say, participation in management, capital, and control. Now, this is direct. They say that even if company A indirectly, through an intermediary, participates in the management, capital, and control of company B, then also they'll become associated to each other. So it could be indirect participation also. I'll give you examples, in the next slide on what is direct participation, what is indirect participation. But this is, what they're actually talking about. So company A will become associated to company B. Now, even if there is same person and this person is participating in the management control of capital of company 1 and the same person is participating in the management control and capital of company 2, well, then also company 1 and company 2 will become associated to each other. Why? Because they have common participation person. They have this same person who's doing that. It's very confusing. What is management, control, and capital? कहीं तो होगा, कहीं तो defined होगा, कुछ तो होगा. Well, yes, I will clarify it, in a while. But right now, these are the scenarios that you need to know where association can actually happen. So it could be direct participation, or it could be one person which is participating here, and this one person is participating here. So these two enterprises will become associated to each other. Let's take an example. Let's say that A Limited is participating in the management of B Limited and B Limited directly participates in the management of C Limited. Well, in this situation, A has direct participation in B, so A and B are related. B is directly participating in C, so B and C are related. And because of this, A is indirectly participating in, C. So this is the reason A has an indirect relation with C. So in this situation, A is associated to B, B is associated to C, and A and C are also, associated in this situation right here because of indirect participation. A is associated to C indirectly through B Limited. So there is association, right here. These are called as associated enterprises. Now, because these situations were very, very generic, we actually rely on section 92A2. What is section 92A2? Well, I just advise you to open, the section and look at the 13 instances out there. Let's look at the section if you have, the act handy, or, if you can just quickly take out the section, just read through what section 92A2 actually looks like. Just have a look at that particular section. Well, if you look at section 92A2, it talks about 13 instances. What are these 13 instances? It says, for the purposes of subsection 1, two enterprises shall be deemed to be associated enterprises if these 13 instances are matched. So what section 2, subsection 2 has actually done is they have actually defined these 13 instances out there. They say that if two enterprises follow any of these 13 instances, if they fall under any of these 13 instances, two enterprises will be associated to each other. So what I've done is, going forward, we will be discussing these 13 instances out there. That is what we will be discussing. Now, what I've done is, for our clarity, just for you guys to remember, because you could have questions on associated enterprises. If two enterprises are associated or not, they'll give you like a case study and you have to identify whether these two enterprises are associated or not. You'll have to remember all these 13 conditions. So what I've done is, for ease, I have divided these 13 conditions into three categories: capital, management, control. These are capital conditions, 4. These are some management conditions right here. And then I have some control conditions, right here. So this is what we will be, discussing going forward. But at this point, I'd just like to mention that law does not define them under capital management and control. This is what I have done for you guys to remember it better. But law does not give that kind of, distinction out there. Law just says that, these are the 13 instances right here. So let's see, what are these 13 instances? Well, let's look at section 92A, subsection 2, clause A, which talks about direct or indirect holding of, shares. So it says direct or indirect holding of shares carrying 26% or more voting power. That basically means that if one enterprise holds 26% or more voting power in the other enterprise, they will become associated to each other. Now it says voting power. So that basically means that if, let's say, company A, it holds 26% or more equity share capital in company B, well, then it will be associated to each other. Can you quickly tell me, what if company A holds 28% preference share capital in company B? Do you think they will be associated to each other? What if company A holds 28%? Okay, we have answers right now. Do you think they will be associated to each other? Okay, no, that's absolutely correct. Because if you actually look at how the law is worded, it says voting power. That basically means that it is voting power that you're actually looking at. This is the reason I mentioned equity share capital holding. So if one enterprise holds 26% or more, so it could be 26%, it could be 35%, it could be any random number out there more than 26%. As long as it's holding more out here, then they will be associated to each other. But you have to remember equity shareholding, voting power holding, not preference share capital, holding. And what you have to remember are these numbers right here. At 26%, they become associated to each other. And obviously 27, 28, 29%, going forward. But at 26%, yes, they become associated to each other. Clause B says direct or indirect holding of shares carrying 26% or more voting power by same person in each enterprise. This basically means that if this person holds 26% or more in company 1 and the same person holds 26% or more in company 2, well then company 1 and company 2 will become associated to each other. But again, you have to look at 26%, more than 26%. And again, this is also voting power. So, the same thing, equity share capital holding or voting power holding, basically. So that is A and B. Let's take an example here. A Limited holds 33% voting power in B Limited. So A and B are associated to each other because it is more than 26%. B Limited holds 80% in C Limited. So obviously B and C are associated to each other because it's more than 26%. What do you think about A and C? A is associated to B. B is associated to C. Do you think A and C are associated? No. Yes, they will be associated because this is called as indirect association. So if you actually look at the law, it says even indirectly holding of shares is going to call them as associated. That basically means that A is associated to C indirectly through this particular intermediaries. So this is the reason A and C will be associated to each other. Now, at this stage, I'd just like to mention, there are judicial decisions which will actually tell you to calculate. So there are some people who would actually calculate, this is 33%, this is 80%. So how will A Limited hold C Limited in that particular, sense? But at the same time, this is association that we're talking about. You are participating in someone's company, and this is majority participation, more than 26%, participation that phase. So there are judicial decisions where it says that, you have to calculate. And there are decisions where it actually says that participation is enough. Even if this is, indirect participation, it is still participation out there, even if it is, less than 26%. We're not getting into those kind of details. Obviously, when you start to practice and if you get into this particular area, you will see all these situations. But from an examination point of view, we're not getting into those kind of details right here. But it'll be interesting to analyze decisions to see whether they look at a number or they do not look at that kind of number out here. But indirect participation is will call them associated enterprises. In this example, let's say that Mr. A, they hold 40% in X Limited and Mr. A also holds 40% in Y Limited. So this is the reason, because this is more than 26%, both situations, X and Y Limited will be associated to each other by virtue of B, clause B. The next situation is clause C, which is provision of loan not less than 51% of book value of total assets. That basically means that if one entity gives loan to the other entity, and what kind of loan? Well, this loan should be 51% or more of the book value of total assets of the other enterprise, then the two enterprises will be associated to each other. Let's take an example. Let's say that there is Y Limited. Y Limited has book value of total assets, which is 100 crores. Now, X Limited gives a loan of 60 crores to Y Limited. This is the reason Y and X and Y will be associated to each other. Why? Because if you give loan of more than 51% or 51% to the other enterprise, they will become associated to each other. Now, there are a lot of things that you need to know in this situation also. The first thing is that there is loan advancement and we are looking at 51% or more. So if you give loan of 51%, at 51%, they will become associated to each other. More than 51%, obviously, they will become associated to each other. Second thing that you have to see is book value of total assets. So we're not looking at market value of assets. We're not looking at anything. We're looking at the book value of total assets out there. So if that is the situation, then X and Y or two enterprises will be associated to each other. So this is clause C, which is provision of loan. Clause D is guarantees not less than 10% of total borrowings. So in clause D, they're talking about a guarantee transaction. I'm going to explain this also with the help of an example. Let's say that P Incorporation has a loan of $1 million from XYZ Bank of America. Now, there is an A limited company, an Indian company, and they give a guarantee to the bank that if there is default which is made by P Incorporation, company A will come in and fill in for that. So company A gives a guarantee of 20%. Because they've given a guarantee of 10% or more of the total borrowings, P Incorporation and A Limited, they will become associated to each other. So what you have to remember in this situation also is that the guarantee should be 10% or it should be more than 10%. But at 10%, they will become associated to each other. Okay. Any question? Okay. Next thing that I want you to know is at any time during the previous year. Now, there are questions that are asked on this particular situation also. What is the meaning of at any time during the previous year? Well, let's say I'm going to give you an example for this. Let's say throughout the year, let's say, throughout the year, the association was for A Limited and B Limited. A Limited held 15% in, B Limited. Now, on, 31st of March, the association was, let's say, 27%. So in this particular situation, they will be associated to each other. But let's reverse the situation. Let's say in July of 2024, A Limited held 50% of B Limited. But on 31st March 2025, A Limited held 15% in B Limited. So I'm going to put them in the chat box right here. June of 2024, A Limited held 51% in B Limited. Okay. And 31st March 2025, A Limited held 15% in B Limited. What do you think for the year 2024-25? Do you think they will be associated to each other or not? For this year? Yes, they will be associated. Yes, that's absolutely correct because the law says at any time during the previous year. At any time, if they are associated, we're not looking at anything, then they will be associated to each other. So, That is the meaning of at any time. The reason that I'm, giving you these specific instances is because there are in the past questions being asked on these small, small things. So you should take them into consideration. The reason that I'm telling you 26%, 51% is because you should know whether at 51% will they be associated, at 10% will they be associated. This is what, you should remember, these thresholds. Now, the next condition is E and F. E and F talks about, management conditions out there. They basically say that if you appoint more than half of the board of directors in the other enterprise, let's say in company B, there is a board of directors. Okay. If company A appoints more than half of the board of directors in company B, well, then company A and company B will be associated to each other. There's an example here that I will, explain this example. Let's say X Limited has 15 directors on its board. So this company B, let's say that this has 15 directors on its board. So the board of directors comprises of 15 directors out there. Now, if A appoints, let's say, 8 directors out of those 15 directors, will they be associated or not? So this company B has 15 directors. Company A appoints 8 directors out of those 15 directors. Do you think A and B are associated? Associated, yes. Yes, absolutely. They will be associated to each other because more than half of the board of directors was appointed there. There was a question which came in the exams, and it's provided in the slide deck also. Let's say that company B has a board of 4 directors. Company A appoints 2 out of them. Do you think they will be associated? 4 directors, 4th board of directors, company B, company A appoints 2. That's absolutely correct. They will not be associated. Why not associated? Well, that is because the provision says more than half. And 4 out of 2 is exactly half. It's not more than half. Another thing that you have to remember is F, clause F, which basically says when there is appointment of one or more executive director. So meaning to say, sorry, just give me a minute. Sorry, just allow me a minute. My laptop has suddenly started making some noise. Which basically says that if company A appoints one or more executive director or executive member in the other enterprise, well, then they will be associated to each other. So let's say company A appoints one or more than one executive director in company B, well, then company A and company B will be associated to each other. Now, what they're actually talking about is executive directors in the law. Do you think independent directors count as executive directors? Independent directors as executive directors? No, that's absolutely correct. So, independent directors' appointment will not count. It is only executive directors or executive members. If you appoint those, they will be associated to each other. Let's take an example here. Mr. A appointed 9 directors out of 15 directors of company X, and Mr. A also appointed 2 executive directors on the board of company Y. Do you think they will be associated to each other? So there is Mr. A, they appoint 9 out of 15 directors of X, and they also appoint Mr. A 2 executive directors on Y. Do you think X and Y will be associated? Yes, that's absolutely correct. X and Y will be associated. Why? Because it's the same person, Mr. A, who's actually doing that. So this is Mr. A appoints more than half of the board of directors in company 1. They also appoint 2 executive directors in company 2. So company 1 and company 2, they will be associated to each other. These are, the management conditions out here. Now, the next set of conditions that we have are control conditions. The first one, which is G, clause G out here, which says complete dependence on intangibles for manufacturing, processing, or for business. This basically means that, let's say there is one entity, it is manufacturing or it is processing or it is undertaking some business. How is it doing that? Well, that is because it's using another company's intangible. To give you perspective, let's say that there is company A. Company A is manufacturing. How is it manufacturing? Well, that is because it is using company B's intangible property, and it is completely dependent on company B's intangible property. There is complete dependence out there. Without company B's intangible property, company A cannot really develop, or manufacture that particular commodity. Well, then company A and company B, they will become associated to each other. And this is the reason. Now, do you see that how company A is so controlled by company B that if company B stops their intangible or does not give them the right to use that particular intangible, company A's business will actually come to, a fault. That is the reason these two will be called as associated entities. And what you have to remember out here are two things. The first thing is that this clause talks about complete dependence. So there is 100% dependence that you're looking at. And the second thing is, I've provided the law here. This is just an excerpt, but I would just advise you to read through the law as well. Just read through the entire language of what clause G actually talks about. This is what is mentioned here in the notes. You can rely on that also, but this one actually says that you have to make sure that company B, which is giving the intangible, this is the owner of the intangible. It should not be that company B has taken the intangible from somewhere and is using someone else's intangible. No, company B should be the owner of that particular intangible and is giving it to company A, and company A's business is 100% dependent on it. So this is where G will come into existence, and company A and company B will now be associated to each other. Similarly, H and I, they talk about supply of raw materials. So if one entity supplies raw materials, let's say 90% or more to the other entity, and the prices and conditions are influenced by the other enterprise, they are not open market, decisions, well, then they will be associated to each other. I talks about goods manufactured or processed by one enterprise are sold to the other enterprise, and prices and conditions are influenced by such other enterprise. So there is a price influence, condition out here. Otherwise, if there are open market conditions, obviously they will not be associated. But because prices are influenced, these are associated entities. J talks about common control by individual and or relative. This is very interesting. This one talks about, let's say that Mr. A and Mr. B are relatives. Relative for the purposes of Income Tax Act. So whatever is the definition provided there, that is the definition that you have to rely on. So Mr. A and Mr. B are relative. Mr. A controls X Limited. Mr. B controls Y Limited. This is the reason X and Y will be deemed associated. Why? Because A and B together, they hold X and Y. So X and Y will be associated to each other. Then they talk about common control by HUF and or its member or relative. This means that HUF, let's say it controls A Limited, and the HUF's relative or the member of the HUF or the relative of the member of the HUF, they control B Limited. In this, A and B will be associated to each other because the HUF and the member of the HUF. So they together, they control A and B. This is the reason A and B will be associated to each other. In case of L, they talk about firm, AOP, BOI. If you're talking about firm, association of person or body of individual, 10% or more interest will qualify as association. And finally, clause M, they talk about relationship of mutual interest as may be prescribed, but nothing has been prescribed by OECD as yet. So these are, the conditions that you have to take into consideration. So these are, as I mentioned, these 13 instances. Again, just saying that just for you guys to remember, I have divided them into capital management and control. It's just easier to remember. Otherwise, if you read through the law, it just talks about these 13 instances. So if two entities, they fall under any of these 13 instances, they will qualify as associated enterprises. And if they become associated enterprises, let's say that if these two companies, A and B, they become associated enterprises, well, then they will have transfer pricing applicable on them. They will have to make sure that they are transacting at arm's length price, and all the transfer pricing compliance will also be applicable onto them. So that is the relevance out there. This is a question that talks about associated enterprises. What I generally do is, in the next lecture, I will also help you revise, through the topics that I've discussed. So next lecture, we will also, first we'll do a revision and then we will take on the other topics. So when we do the revision, generally I take up the questions, then if you're happy with that, I'm absolutely fine following that approach. If not, I can just discuss the questions right now. So what you want me to do? Should I discuss the questions right now, or should I do that in the next lecture when I revise through? That helps us revise through. Okay, now. Oh, okay, we can just discuss the questions, right now, because there's majority here. Okay. So, why don't you guys take a minute and read through the questions, right here. Just take 2 minutes. I'm going to give you 2 minutes. Read through the question and then we will, discuss it. It's 8:13, 8:15, we'll discuss the answers. Okay, so are you guys with me? Can you hear me? Great. Thank you so much. So, we were discussing whether these three enterprises, these three situations, where whether they will be associated or not. In the first situation, we're talking about NLLC, and they have advanced a loan of 53 crores to B Limited, and this is on 12th January 2024. The book value of assets is 100 crores, market value is 150 crores, and they have also repaid something. Do you think they will be associated? And then I will talk about, why and how. Yes, they will be associated. Why they will be associated? Well, that is because they have advanced a loan of more than 51 crores. They have a 51% to the other enterprise. Now there are a lot of things that you need to take into consideration with respect to this particular example. The first thing is you have to remember the law. The law says 51% or more. So 51% will count, or more than obviously 51% will count. The second thing is book value of total assets. So the thing that you have to remember is 100 crores and not 150 crores. And the next thing that you have to remember is whether they have repaid 10 crores or not, it's not going to be taken into consideration. Why? Because at any time during the previous year, at any time, they had 100 crores of loan. Whether they repaid 10 and now it becomes 90, that's another thing. But at one point in time, it was 100 crores. This is the reason they will be associated, right here. Yes, absolutely. It's written in the chat box also. You answered it correctly at any time during the previous year. So these are, some things that you have to take into consideration and remember right here. The second one, do you think they will be associated? I think this is one that I have covered in the examples also. So they will not be, associated. Why? Because it's not more than 51%. Sorry, it's not more than half. It's not more than 50%. It's absolutely 50%. Okay, the third one, do you think they will be associated? Okay, any other answer? Well, they will not be associated in the third one. Can you tell me why? Not associated. I think you just looked at supply, of raw materials 90% or more. Obviously, it is 90%, but this is a very tricky one. So, yes, it is obviously 90%, but it is more than 90%, but still they're not related. They're not associated. Why? This is, I have provided the law. Exactly. It is because the prices are dependent on market conditions. If you look at the law, it says the prices are influenced by the other enterprise. That is not the situation here. The prices are not influenced, the prices are dependent on market conditions. And if they're obviously dependent, they're not associated enterprises. This is the entire thrust of transfer pricing, and this is the reason they will not be associated in the third situation. So what I'm saying is, you'll have to read through the law, and you'll just have to make sure that this is followed. This is the question, and the last part is just for your reference. This is the excerpt from the law. This is what the law basically says, not the exact language of law, but this is what the law really says for your understanding. And this is just like a, okay, I think I should mention it here. Hint. This is the hint, and this is the question right here. Okay. Okay. Shall I move forward? So this is, if you see, this is section 92A and 92 subsection 1 and 92A subsection 2 that talks about associated enterprises. I'd advise you to just go through all the clauses here, the 13 instances, so to remember them and know whether the two entities will be associated or not. Now, when you know that two entities are now associated to each other and now they're related to each other, the next thing to establish will be to find out whether this is an international transaction that we're talking about or not. Because transfer pricing, as I mentioned, is applicable on international transactions. This is Section 92B of the Income Tax Act 1961. So now what is an international, transaction? Well, if you look at the terminology international transaction, obviously this is Section 92B of the Income Tax Act, and it talks about transactions between two or more associated enterprises, either or both of whom are non-residents. If you look at, the kind of transactions that they have covered for international transaction, these are a lot. These are first tangible, property transactions. So if one entity sells, like a tangible property to the other entity, sells a building, vehicle, machinery, anything, a tangible property to the other entity, this is going to be called as an international transaction. I'm going to explain this in a while. Just, allow me some time. Either or both of whom are non-residents, I'm going to explain this. But just if one entity sells or purchases, or if there is a transfer, if there is a lease, if there is a use by the other entity of tangible property, it's going to be an international transaction. Even intangible property transactions will be covered. So if one entity, sells intangibles to the other entity or purchases intangibles, even when there is right to use intangible that is actually provided or intangible is actually transferred, then also it's going to be called as an international transaction. So it could be anything. It could be, copyright, it could be patents, trademarks, etc. I will tell you where intangible property is defined. This is a defined terminology for the purposes of transfer pricing. So yes, even if there is an intangible property transaction, this will also be, covered. So this will also, be covered right here. This is also an international transaction. Now, what else can be an international transaction? Well, capital financing can also be international transaction. So if one entity provides loan to the other entity, that is also an international transaction. If one entity gives a guarantee to the on behalf of the other entity, this can be a loan transaction. Even if issue of share kind of transaction, purchase and sale of securities, etc., these are also intangible. These are also international transactions. This is very interesting because it says advances and receivables. So even if there is a transaction that is appearing every year, which is, outstanding balances, outstanding receivables, outstanding payables, and this is a transaction between two associated entities, it's like it's every year which is occurring, then also it's going to be an international transaction for the purposes of Section 92B. So let's say that, there is like a valid transaction. Year one entity has given services, to the other entity. Now, year two, they have outstanding, balances out here. They have outstanding receivables in their, balance sheet out there. So year one, this transaction of provision of services, it will be an international transaction. Year two, even if there is no provision of services transaction, but there is that outstanding receivable which is out there in the balance sheet, that is also an international transaction for the purposes of Section 92B. This is what the section really says. Advances, receivables, etc. These are also transactions. Meaning to say that you will have to undertake transfer pricing analysis for that also. Then there is provision of services. So if one entity provides services to the other entity, these could be IT services, ITES services, this could be legal services, accounting services, market research services, etc. If one entity provides services to the other entity, this is going to be a valid international transaction. And finally, there is a business restructuring transaction. So, all the merger transactions, demerger transactions, etc. These are also considered as valid international transactions. Now, it's not just restricted to that. I should just tell you that, we were talking about the OECD and the UN transfer pricing manual. This is where this is so detailed, these particular manuals, that they have these individual chapters on what is transfer pricing, how to apply the arm's length price, what are comparability factors, and then they have separate chapters on all these things. Also, they have a separate chapter for intangible property. This is chapter 6 of the OECD and the UN transfer pricing manual. Then they have chapter 9, which is on business restructuring. They have a separate chapter on capital financing, etc. So they have separate chapters on how transfer pricing is undertaken for all these situations right here. This is how the law is worded. So everything that I explained is provided here. You can read through this. But what I want to explain is the meaning of the terminology transaction. Now, this particular terminology transaction is defined in Section 92F of the Income Tax Act. What does Section 92F really say? This one talks about the meaning of the term transaction, and it says that it includes an arrangement, understanding, or action in concert, whether it is formal, whether it is in writing, whether it is enforceable by legal proceedings, etc. So what they're really trying to say is that you don't really need a formal written agreement between two entities to have a transaction. It is only relevant whether the transaction has been undertaken in substance. So a transaction has to be entered into, whether it is written, whether it is formal, whether it is in writing, whether it is legally enforceable or not. That is not really required for the purposes of transfer pricing. There has to be a transaction between two entities that has to be entered into. So this is what it actually talks about. Next thing that they actually mention about is very, very interesting. I just advise you to take 2 minutes again and read through these two paragraphs. It'll make more sense if you just read through it. So just take a minute, read through these two paragraphs, and I'd like to actually discuss this in a lot of detail, because this is where again questions could be asked. Okay. So this one actually talks about whether two enterprises will be associated or not, and how will you actually treat a particular enterprise as a resident or a non-resident. So this one basically talks about, let's say, a resident assessee, A Limited. This is a company incorporated in India. So this is a resident assessee for the purposes of India's tax law. It has foreign branches. Now, the transaction between A Limited and the foreign branches will not be considered as an international transaction. Why? That is because when you talk about A Limited being resident in India, all the foreign branches will actually be considered as deemed resident in India. And obviously, if there is a transaction between the head office and the branch, the head office being in India, it's not going to be a transaction between, foreign entities. This is going to be a transaction, between. This is going to be not considered as an international transaction because you're not talking about a transaction between, a resident and a non-resident. You're just talking about transaction between residents out here. On the other hand, if you talk about an Indian branch, let's say there is a foreign company, B Limited, it's a foreign company. It has Indian branches out here. The transaction between this B Limited head office and it has, Indian branches out here, this will be considered as, an international transaction. And this is because this Indian branch, it will be liable to tax in India. This is called as a permanent establishment, and this permanent establishment is liable to tax in India. So this is going to be considered B Limited as a foreign entity, and this will be an Indian entity. And this is the reason the transaction between these two entities will be considered as an international transaction, and this will be liable to arm's length price. Do you think it makes sense? Do you think it's very confusing? Oh, not confusing. Okay, great. I have, from my, experience, I've seen this being a little confusing, and there has been, uh, questions here. So I thought I'll, just discuss this. Okay, so this is what we've discussed today a lot. Now, the next topic that we have is deemed international transaction. This topic is again a little confusing, it's a little technical. So, what I've done is I've actually created a diagram out here to explain this particular topic. And this is what is the wording of law. I can tell you that if you read through the law, alone, it's going to be a little technical. So, I would advise you to just, read through this particular law in sync with the diagram right here. And this is what I've decided. This is what I'm going to start my next lecture with, which is deemed international transaction. So for the next lecture, I have deemed international transaction that I start with. We'll discuss, what the law basically says. There has been amendment in the law and this particular example. After that, I will start with, some practice questions for the purposes of whatever that we actually discussed today. And this is the means that, how I actually revise also through, the concepts. Before we actually do a quick revision of what we've discussed today, this is what I wanted to discuss. This is explanation 2 to section 92B. Anyone who can tell me what was section 92B? Very quickly. What was section 92B that we discussed? Okay, Section 92B was the meaning of international transaction. So, as I mentioned, when it comes to international transaction, even intangible property is considered as an intangible transaction. So, what India has actually done, it has defined intangible property in a very, very detailed manner, and they have provided explanation to right here to identify intangible property. Now, this is how intangible property is defined. They have these 10 situations out here, and they basically say that all these will be considered as intangible property. So it's marketing related intangible assets, technology related, artistic, data processing, engineering, customer, contract, human capital, which is workforce, location related intangible property, goodwill is considered intangible property. So all the patents, trademarks, etc. If you read through this particular definition in India, it's going to be it's a very, very wide definition of intangible property that we have in India. But this is how they have actually defined. And if there is a transaction between two associated entities which deals with any of these properties, this will be considered as a valid international transaction. So this is explanation 2. And after this, I have, some practice questions. So what we discussed for today is, just to give you a little bit of perspective, was to, discuss what is transfer pricing. Before transfer pricing, there was a lot of, tax avoidance strategies that were actually happening. Profit shifting from high tax to low tax jurisdiction, that was actually happening. And this is the reason they came up with transfer pricing law. And transfer pricing law will make sure that everything happens at arm's length price. What is the arm's length price? The price that happens in independent party situation, but comparable in the independent party, situation. How are they comparable? Well, using these, 5 factors right here: contractual terms, FAR analysis, characteristics of property services, economic circumstances, and business strategies. So this is called as the arm's length price. Where is the arm's length price coming in from? It's coming from arm's length principle. Why is arm's length principle called as international consensus? Because most of the nations have given consensus on using arm's length price for the purposes of transfer pricing. After that, we discussed, the situation in India, and now you know that this is Section 92, which says that we also use something called as the arm's length price. Then there is Section 92A, which talks about, the meaning of associated enterprises. This is how transfer pricing will now become applicable. Only when two enterprises are associated will transfer pricing be applicable. So there is participation by capital, management, and control. This is how they've defined capital. So they have these 4 instances for capital: 26% or more voting power, provision of loan 51% or more, guarantees 10% or more. Then there is management, which is board of directors, more than half. Executive director, even one executive director appointment will become, association. And then they have these control conditions. A lot of dependence. It could be dependence on intangible, it could be on supply of raw materials, goods manufactured, or if there is common control by individual and their relative, common control by HUF and their relative, etc. This will become associated. And then there is international transaction. All these situations are international, transactions, but for the purposes of international transactions, you need to have, these situations applicable. So it is a transaction between, a resident and a non-resident that will qualify as, an international transaction. A transaction between two Indian entities for this purpose will not be an international transaction. That will be specified domestic transaction, which is, something else, and which is what we will discuss, later. That is where transfer pricing, it impacts domestically also. So that is, something that we will discuss. In the next lecture, we will start with the concept of deemed international transaction and go forward. And then we will discuss the method compute arm's length price. Next lecture is going to be a little technical and very important, because that is where we'll discuss an important concept, which is the methods to compute the arm's length price. So that is all that I have, for today. And I will see you again very soon. If you have any questions, I'm happy to answer them right now. Otherwise, I'm happy to connect. And thank you so much for the lecture today. Any questions? Okay. Any questions? Okay, if there are no questions, thank you so much for today. And oh, thank you so much. Thank you so much for these wonderful comments and the wonderful feedback. And I will see you guys in the next lecture. Thank you so much. See you. Sir, we can stop the recording. Anji, sir.